All right, so continuing on with part B of our lecture, if you change your estimate, either the estimated life of an asset, or its estimated salvage value, or both, that's a change in estimate, and as such, you have to change your depreciation rate. And so you do so, or at least the amount of depreciation expense. And so that's a change in estimate. It is accounted for prospectively, meaning going forward. We don't do like we've seen before and change our numbers retrospectively. And so we just simply calculate the new uh, depreciation expense based upon the remaining depreciable base divided by the remaining estimated useful life. You also have to disclose in a disclosure note the effect of the change for the current period on net income as well as related per share amounts. Of course, this would have to be fairly material change in estimate for you to do so. If it was just, a little piece of equipment, obviously for a big company, that's not going to be material. So here we have an estimate change. This company purchased office equipment on January 1, 2016 for $250,000. At the time, they expected the service life to be 5 years and the anticipated value, salvage value of $40,000. So again, the depreciable base is $210,000. Fiscal year end is December 31st, and straight line depreciation method is used. On January 1 of 2018, so 2 years later, the company revised its estimate of the service life from 5 to 8 years, so they're extending it, and the estimated residual value from 40,000 down to 22,000. So at the time of the change, their book value is going to be $166,000. You're going to take that book value as of the date of the change in the estimate. You're going to subtract the revised residual value. That's going to be the remaining allocation base or depreciable base, and you're going to divide that depreciable base by the estimated remaining life of 6 years. So starting in 2018, this company is going to have a depreciable or depreciation expense of $24,000. So here we have a concept check. On January 1, 2018, the Esquire Corp purchased equipment at a cost of $165,000. The equipment was expected to have a service life of 10 years and a $15,000 residual value. The straight line depreciation methods used. So in 2020, 2 years later, the estimate of residual value was revised from 15,000 to 0. Depreciation for 2020 should be, okay, so your depreciable base is $150,000, 165 minus 15, and so at the end of the second year you would have depreciated $30,000, and so your book value at the end of that second year is $135,000. You don't have to subtract any salvage value because it's now at 0. So you simply take the book value as of 2020 of 135,000, and you divide it by the remaining useful life, which is 8 years. So 135 divided into 8 is 16,875. So the answer is B. And of course, if you have a change in estimate, you're going to have to disclose it. However, if you notice this, this actual disclosure deals with a change, not in estimate, but a change in accounting method. So that's also something you have to disclose. All right, so let's talk about change in depreciation, amortization, or depletion method. Sometimes, as I mentioned before, you change from, let's say, a double declining balance method somewhere usually halfway through the estimated useful life of the asset to straight line method, because that way you get better utilization of your depreciation expense over the life of the asset. And it may actually come closer to describing the utilization of an asset, a lot more utilization in the first years of the asset's life, and then kind of smoothing out somewhere in the middle. And so, a couple of things, and I think we've mentioned this before, not sure when, it may have been last term, but a change in accounting estimate is a change in accounting principle. However, even though it is a change in accounting principle, we don't go back and change the numbers in the past, meaning retrospectively. This is accounted for in the same way as any other change in accounting estimate, so it's done prospectively. But because it's a change in accounting principle, there has to be a clear justification as to why the new method is preferable. Okay, so for that reason, it is considered a change in accounting principle. All right, so here we have another example. On January 1, 2016, Hogan purchased a machine for $250,000. The company expects the service life of the machine to be 5 years. Anticipated residual value to be $30,000. Company's fiscal year end is December 31, and double declining balance depreciation method is used. During 2018, the company switched from DDB to the straight line method. Okay, so here is that. You've depreciated. 220 is your depreciation base. You depreciated 100,000 in the first year and 60,000 in the second year. And so your book value at the time of this change is going to be $90,000. From that, you're going to subtract the salvage value of 30,000. So your depreciable base at the time of the change is $60,000. You're going to take that amount and divide it by the remaining useful life of 3 years. And so under the straight line method, going forward for 3 years, you're going to have depreciation expense of $20,000. And again, like we saw before, when you change depreciation methods, you have to justify it and disclose it in a disclosure note to the financial statements. All right, so here we have an example. On January 1, 2016, the Herald Company purchased equipment at a cost of $400,000. The equipment was expected to have a service life of 10 years and a $20,000 residual value. The company's fiscal year end is December 31, and the DDB method is used. During 2018, the company switched to the straight line method. In 2018, the adjusting entry to depreciation expense is, well, let's see. Just figuring this out, your 10-year life, meaning under the straight line method, you depreciate 10%, so multiply that times 2, and you've got your DDB depreciation percentage. And so that first year, you're going to depreciate 400,000 times 20%, so 80,000 for the first year, and then in the second year, you're going to depreciate 320 minus, or excuse me, 320,000 times 20%, so 64,000, so a total of 144. So you're going to take that 144, excuse me, yeah, the 144 and subtract it from the original cost of 400,000, which is going to make your book value at the time of this change 256,000. From that, you're going to subtract the 20,000 residual value. So your depreciable base at the time of the change is 236,000. You're going to divide that by the remaining 8 years. So you're going to depreciate 29,500 in year 2000 and through the remaining life of the asset. Error corrections involving property, plant, and equipment and intangible assets include computational errors in the calculation of depreciation, depletion, or amortization. it also occurs when determining whether expenditures should be capitalized or expensed. I think I told you about the case where some low-level accountant capitalized an $8 billion what should have been an expenditure in a particular year. So they capitalized it rather than expensing it. So income was understated for that year, obviously. And in subsequent years, until they found it, income was overstated. So if you have a material error, either computational in the calculation of depreciation or a mistake in capitalizing versus expensing, could be should have capitalized, but you expensed, or it could have been should have expensed, but you capitalized. Either way, whether it's a computational error or a mistake in capitalizing versus expensing, if it's material, you have to go back retrospectively and correct previous year's financial statements. So any account balances affected by the computational error or mistake must be corrected, and if retained earnings requires correction, which it many times does, you have to make a prior period adjustment to your retained earnings. You also have to describe in a note the nature of the error and the impact of the correction on income. So here we have an example where in 2018 the controller of this company discovered an error recording $300,000 in legal fees to successfully defend a patent infringement suit in 2016. The $300,000 to successfully defend a patent infringement should have been capitalized in 2016, but it was immediately expensed, and so it should have been capitalized and amortized over a 5-year remaining life of this patent. Straight line amortization would have been used, and so what you see on the right hand side is what they did. Immediately expensed instead of capitalizing and expensing over a 5-year period at $60,000 amortization expense. And so in 2018 they should have expensed $120,000 worth of amortization expense for the 2 prior years, 2016 and 2017. And so at the beginning of 2018, what they're going to have to do is put $180,000, the remaining amount of the patent that should be on the books, and they're going to have to adjust retained earnings in the same amount. So it's the difference between the amount of the expense they took versus what they should have taken in those prior years. In this case, the difference is $180,000. All right, so here we have an example. In 2019, the controller of the Depot Company discovered that 2018 depreciation expense was understated by $100,000, a material amount, assuming an income tax rate of 40% the prior period adjustment to 2019 retained earnings, beginning retained earnings would be. Well, in this case, what has happened? So it was depreciation was understated, which means that retained earnings is overstated by 100,000 minus the tax paid on it, 40,000. So bottom line is the after-tax effect is an overstatement of $60,000 in retained earnings, and so you're going to debit retained earnings $60,000. All right, impairment of value. So up till now, we've been assuming that the cost of an asset over its useful life indicated that the value of the asset was at least as much as its value or cost or book value. But sometimes there's a reduction in the benefits that you expect to receive from an asset. And so when you have such a decline or impairment of these benefits, you've got to reduce the value to, well, reduce your book value to the fair value. All right, so here we have an example of a building destroyed by fire before the asset's fully depreciated. What you're going to do is you're going to take, in that case, it's apparently totally destroyed, so you're going to take the remaining book value and you're going to write off the asset. So basically what you're going to do is take this off your books by debiting accumulated depreciation, crediting the original book, original value or the original cost of the building, and of course you're going to have more credits than you do debits at that point, and the remaining debit's going to be your loss on disposal of, or an impairment loss on this asset. Now how you measure, recognize and measure an impairment loss depends on whether the assets are to be held and used or they're being held for sale. We may have touched on this before, but if so, we'll touch on it again. If these assets are planning on being used in the future, they should be written down if there's been a significant impairment of value. What is significant? I suppose if it's material. So here we have an example. In 2015, Murphy Oil Corp recorded impairment charges of $2.4 billion. The charges reflect the decline in asset values associated with lower oil and gas prices. So, um, this could be, and it's not uncommon for oil and gas companies to do that, especially in this last downturn just a few years ago. But I think the book points out at some point here in this chapter that it may also be part of the big bath theory that we talked about last term. It creates an understatement of income and assets for the current period, and it overstates income in future periods. Now, it is difficult to measure the amount of the required write-off so you have different rules depending on whether you're dealing with property, plant, and equipment and intangible assets that have finite useful lives versus intangible assets with indefinite useful lives, because that last category, intangible assets with indefinite useful lives, don't have, are not subject to amortization. So when you're dealing with property, plant, and equipment and finite intangible assets, it says according to GAAP, assets are grouped at the lowest level for which identifiable cash flows are largely independent of the cash flows of other assets. That's usually at a division or subsidiary level, but it could be a particular plant or something like that. So when do you test for impairment? You test for impairment here only when events or changes in circumstances indicate that the book value of the asset may not be recoverable. Okay, so that's, if there's a downturn in the market, the book value of the asset may not be recoverable. So here are some events that might be or might spur on such a analysis: a significant decrease in the market price, significant adverse change in how the asset's being used or its physical condition, significant adverse change in legal factors or the business climate, an accumulation of costs significantly higher than the amount originally expected for the acquisition or construction of an asset, current period loss combined with a history of losses or a projection of continuing losses associated with the asset, or a realization that the asset will be disposed of significantly before the end of its estimated useful life. All right, so for depreciable, tangible, and intangible assets, figuring out your impairment loss is a two-step process. Step one is called the recoverability test. And so there you determine whether or not the undiscounted sum of the estimated future cash flows from this asset is less than the asset's book value. If the answer is yes, the undiscounted sum of the estimated future cash flows is less than the asset's book value, then you go to step 2. You measure the impairment loss by comparing the asset's book value to its fair value. If it's impaired, you recognize an impairment loss. If it's not impaired, meaning the fair value is more than the asset's book value or the same as, then you're not going to do anything. Now, many times, what you have to do to figure out the fair value of an asset is you have to figure out the discounted sum of estimated future cash flows in that step 2. And so the written down book value becomes the new cost base for future cost allocation, meaning you take the written down book value and depreciate it over its remaining useful life. Now, what is fair value? The definition is it's the amount at which the asset could be bought or sold in a current transaction between willing parties. But I'm telling you many times that this is done calculating the discounted future cash flows. So just so we're clear on this, in step 1 you take the undiscounted estimation of cash flows and compare it with the book value, and if the undiscounted estimates of the cash flows is less than the book value of the asset, then you go to step 2. And many times in step 2 you're using the discounted estimates of cash flows to figure out fair value. And again, as we've seen before, you have to disclose in a note describing the impairment loss. It should include the description of the impaired asset or asset group, the facts and circumstances leading to the impairment, the amount of the loss if not separately disclosed on the face of the income statement, and the method used to determine fair value. So here we have the Dakota Corp. Operates several factories that manufacture medical equipment. Near the end of the company's 2018 fiscal year, a change in business climate related to a competitor's innovative products indicated to management that the $170 million book value, which is the original cost of $300 million less accumulated depreciation of $130 million, of the assets of one of Dakota's factories may not be recoverable. Management is able to identify cash flows from this factory and estimates future cash flows of the remaining useful life of the factory will be $150 million. The fair value of the assets is not readily available, but is estimated to be $135 million. All right, so step 1, estimation of, I assume, undiscounted future cash flows is less than or less than the book value, 170 minus 150, so it's $20 million less. And so they have to go to step 2, and the estimated fair value is 135, and the book value is 170. So they're going to take an impairment loss of $35 million. And note what they do here. If they're taking an impairment loss of $35 million, that means they need to get their book value down to 135. And so what you're going to do here is you're going to wipe out any accumulated depreciation, prior accumulated depreciation, in this case 130 million. You're going to take your loss on impairment of 35 million, so you've got your two debits, and in order to get the factory asset here, or assets, down to 135 million, you're going to credit factory assets for 165 million. So now you've got your debits and credits equaling each other. So you might have to do some T account analysis on this one, but at least you know, number one, you know your loss on impairment. Number two, you know you have to debit any prior accumulated depreciation as part of your journal entry. And then the difference is going to be a credit to the asset. All right, so here we have an example. Hallberg Inc. owns a factory for which it paid $270 million at the end of 2018. The book value of the factory's assets totaled $189 million. Due to adverse economic conditions, Hallberg's management determined that it should assess whether an impairment loss should be recognized. The estimated undiscounted future cash flows to be provided by the factory total $180 million, so that's less than the book value. And the factory's fair value at this point is estimated to be $120 million. That's definitely less than the book value. Under these circumstances, Hall would do what? Well, that's pretty easy, right? C. Record an impairment loss of $69 million. And again, of course, you're going to disclose it. Now, for indefinite life intangible assets other than goodwill, you test for impairment annually or more frequently if events or changes in circumstances indicate that it's more likely than not an asset is impaired. Now, a company has the option of first taking a qualitative assessment to avoid the expense of the quantitative testing, because that usually requires appraisers. So here, measurement of an impairment loss is a one-step process. If the book value exceeds fair value, an impairment loss is recognized for the difference. So there's no recoverability test. Meaning you don't have to mess with undiscounted future cash flows that we did with tangible assets. And so, like we've seen before, if an impairment loss is recognized, the written down book value becomes the new cost base for future cost allocation. Goodwill is its own separate category. It's unique in that, unlike other assets, its cost can't be directly associated with any specific identifiable right, and thus is not separable from the company as a whole. When you're buying a company or the assets of a company, you're buying the fair value of the tangible and intangible assets, but you may be buying much more than that. You may be buying reputation, management skill, etc., 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 name brand, trademarks, whatever. And so when you purchase an asset for more than the fair value of the net assets, there's goodwill built into there, but the only way you can figure out goodwill, at least when you're first applying it, is comparing the acquisition amount, the consideration given, less the fair value of the net assets, and the excess is the goodwill. So it's not like you can separate goodwill from the fair value of the underlying assets. And again, here, if you have goodwill involved in, let's say, a division that you purchased, or a subsidiary, or factory, or something like that, you have to test for impairment at the lowest level possible. And so the division, the subsidiary, or the factory would be the operating segment in this case. Now you have to, management is required to test for impairment once a year, every year. And so measuring goodwill impairment is a two-step process. Step one is a qualitative, and step two is a quantitative, if you will. So step one is management determines whether or not goodwill impairment loss is indicated by comparing the fair value of the reporting unit with its book value, and if fair value is less than the book value, then a goodwill impairment loss is indicated. And so if that's the case, then you go to step two. And you're going to measure a goodwill impairment loss by comparing the excess of the book value of the goodwill over its implied fair value. So the best way to show you this is by example. And again, usually step one is simply a qualitative assessment, so you don't have to go through and have appraisers do step one. So if the fair value of the reporting unit is below book value, the company performs step two to measure the amount of the goodwill impairment. So here's our example. In 2017, the Upjohn company acquired Pharmacopoeia for $500 million. Upjohn recorded $100 million in goodwill, meaning that the fair value of the net assets were $400 million. After the acquisition, Pharmacopoeia continues to operate as a separate company and is considered a reporting unit. At the end of 2018, events and circumstances indicate that it is more likely than not that the fair value of Pharmacopoeia is less than the book value, requiring Upjohn to perform step one of the goodwill impairment test. The book value of Pharmacopoeia's net assets at the end of 2018 is $440 million, including the $100 million in goodwill that was originally recorded. On that date also, the fair value of Pharmacopoeia is estimated to be $360 million, and the fair value of all identifiable tangible and intangible assets, excluding goodwill, is estimated to be $335 million. Okay? I know that's a lot to take in. Well, so in this case, the fair value of Pharmacopoeia is below its book value by, well, 440 versus 360. And so that's the value including goodwill, 360. The fair value of identifiable tangible and intangible assets without the goodwill is estimated to be $335 million. So the difference is the implied amount of goodwill remaining, which is 360 minus 335. So the implied goodwill after the write-down should be $25 million. Well, if it's at $100 million, you're going to have a write-down in goodwill of $75 million. So step one, definitely an impairment loss indicated. So you go to step two, and the implied fair value of goodwill, 25 mil, like I said. So you've got to take an impairment loss, and your new book value of goodwill is going to be 25 million. All right, so here we have an example. In 2017, Malchan acquired Sanchez Company and recorded goodwill of $290 million as a result. The net assets, including goodwill, for Malchan's acquisition Sanchez had a 2018 year-end book value of 1,160 million, so 1,160,000,000, while the fair value of all of Sanchez's identifiable tangible and intangible assets, excluding goodwill, is 900 million. Okay, so fair value of assets and goodwill is 1,020,000 or 1,020,000,000. The fair value without goodwill is 900. So the implied fair value of goodwill is the difference, 120 million. If you've got recorded goodwill at 290 and the implied fair value of goodwill is 120, then you're going to have to take an impairment loss here of D 170 million. If you're holding assets to be sold, again, I think we mentioned this, these are assets that management is actively committed to immediately sell in their present condition and for which a sale is probable if the book value exceeds fair value less cost to sell. An impairment loss is recognized for the difference. These costs are not depreciated or amortized once they are held for sale, and they're also reported separately in the balance sheet. Okay, so that's a summary of the asset impairment guidelines. Now, I mentioned this before, impairment losses and earnings quality, and so if you're analyzing financial statements of a company, you need to be aware that it may affect earnings quality because it's probably going to be transitory unless it's something that's fairly permanent. And so I mentioned by writing off large amounts of assets, earnings are significantly reduced in the write-off year and future earnings are increased and may be overstated by lowering future depreciation, depletion, or amortization. If a company underestimates future cash flows, fair value is understated. The two effects of understating fair value are current year's net income's unrealistically low due to the impairment loss being overstated. Future income's unrealistically high because depreciation, depletion, and amortization are based on understated asset values. All right, let's take a break and we'll do part C, expenditures subsequent to acquisition.